more insight, more understanding. This is Fox 23 News in Depth with Rick Maranon.
You see minorities, unemployment going up. You see younger people who are more vulnerable economically, more susceptible to economic cycles. That's one of the reasons, in addition to just overall lower payroll job creation, that shows you that at the margin, the labor market is weakening.
The Federal Reserve this week dropped interest rates by 1/4 point and said more drops could be coming soon. But what does that really mean for you and me? I asked BOK Financials Chief Investment Strategist Steve Wyett to join me on the program to speak unedited about this. I said, Steve, explain it to me like I'm 5. What does this mean? Steve, the number one thing I've been seeing on social media from folks is they feel like this is a good thing, but they need someone to explain it to them like they're 5. Why is this a good thing, lowering interest rates?
Yeah, well, ultimately, Rick, we're an economy that's driven by access to credit, the cost of credit. And so lowering interest rates, reducing that cost of credit is generally the way that the Federal Reserve pursues monetary policy as a way to spur additional activity. The risk there, of course, is that when inflation gets high, that's why they raise rates to reduce that level of economic activity and let supply catch up with excess demand. So in the end, you are absolutely correct. There's two sides to this equation. If you're a borrower, if you're a corporate borrower, you're borrowing against a short-term index like the secured overnight financing rate, SOFR, or a prime rate loan, those rates are going to come down. Longer term rates, though, where consumers are spending most of their time, like home mortgage rates, Rick, this doesn't have a direct impact on that. But importantly, mortgage rates have been coming down this week. They're down about 50 basis points over the course of this week. That should help. In fact, we've seen recent data, a big surge in the potential for borrowing on home mortgage rates. But as an investor, Rick, I want higher interest rates. I want to earn more money on my investments. There's something like $7 trillion invested in overnight money market accounts. And what that means is that investors in those savings or in those types of instruments, they're going to see their income go down. But in general, again, we're a credit-driven economy. We're going to see credit card rates come down a little bit. You're going to see auto loan rates come down a little bit. And generally, that's viewed as a positive for economic growth as we move forward.
Does this mean the economy's in trouble?
I don't think it's in trouble at this point. That's a fair question to ask. Why is the Fed easing monetary policy? And I do think it's important to keep in mind why the Fed is lowering rates. The important thing for us at this point in time, Rick, is that the Fed is already restrictive in monetary policy. And what I mean by that, before today's action, the target was 4.25 to 4.5% on overnight interest rates. Now it's 4 to 4.25. Both of those, the new target rate is still above the rate of inflation, but the rate of inflation is still above where the Fed's 2% target is. We're running about 3.1% on core PCE inflation. So what has changed from the Fed's perspective and why they decided to lower rates now versus earlier is that we have gotten some recent news, Rick, on the labor market, which shows that the labor market has slowed. It's not weak. Unemployment's still 4.3%. But new job creation has slowed pretty dramatically. And we got a big revision from the Department of Labor looking at the last 12 months, where actual job creation was something like 911,000 fewer jobs than we thought. That's about half of the total job growth that we thought. So how Fed Chair Powell couched this in his press conference is this is a defensive move. It's a move to help make sure that the unemployment rate does not begin to go up a lot higher from now. But it doesn't mean that the economy's in trouble. Consumer spending is still positive. GDP growth is still positive. But this move will help make sure that we extend that positive growth as we move forward.
This was just 1/4 point. It seems like, yes, it's good, but it also seems so small.
Yeah.
Is it really that significant of a move?
So there's two things to think about that. You're right. It is small. Look, if you're a consumer and you're having to use credit card debt to make ends meet, a 0.25% reduction in your rate, which is probably over 20% anyway, that it's not like that's enough to balance your budget, Rick. So you're absolutely correct from that standpoint. From the standpoint, though, of the signal that it sends to employers who may be considering that maybe they need to reduce their work staff, if the signal now is, look, the Fed's going to be lowering interest rates, that should help economic growth on a go-forward basis. So I'm not going to reduce my work staff today because I think in 6 months or 9 months, the economy's going to be better. And I remember how hard it was to hire people during the pandemic. That means some business owners might keep people employed. And Rick, 65 to 70% of our economy is driven by consumer spending. The labor market is the key principle, the key factor that we're looking at as we think about growth going forward. You know, this brings up an important point, Rick, from the Fed's perspective. They have a dual mandate: price stability, where inflation's still a little above their target and in fact has moved higher over the last 2 or 3 months as tariff policies kind of work their way through the economy, but a weaker job market and the Fed lowers interest rates. What that tells me is the Fed's more interested in making sure that the job market stays firm, even if that is at a bit of a different or forces a different move out of the Fed than what they might be getting from their inflation mandate.
So what do you take away as far as future cuts? I know that some are saying half a point, and I think some others are just saying this is just a hush Trump up for a little bit. Where do you see us going in the future? Just hang on and more cuts come?
Yeah, look, I think the fact of the matter is whatever move the Fed makes is going to be painted with some sort of a political brush. So let's just get past that. We don't think this was a political move per se. It is true that the Fed is probably dealing with more political pressure than it has for a while, and I would point to this as an interesting factoid on the meeting today. The vote to cut 25 basis points was 11-1. Now remember, last meeting there were 2 dissents when the Fed did not move. There were 2 dissents from Governors Bowman and Waller, who wanted to begin to lower interest rates at the last meeting. They agreed with this move. The one dissent this meeting was the newest Fed governor, Steve Maranon, who was just approved yesterday and is now a voting member of the Fed. He dissented because he wanted a 50 basis point cut, not a 25 basis point cut. So yes, there's still some things going on there. And if I look at the Fed's dot plot, which is just, I'm not going to say it's a forecast, it's the central tendency of what the Fed's looking at going forward. There's 2 more rate cuts built into this year's forecast. And a little bit different, the market was expecting as many as 3 rate cuts next year. We always felt that was a bit aggressive. The Fed's dot plot now has only 1 additional rate cut, so a total of 4 today, and then 3 more, 2 more this year and another one next year. That's about where we were forecasting, but Governor Maronon's rate forecast was for 5 rate cuts this year. So he's clearly an outlier on what the Fed's consensus is. But remember, with the FOMC, 12 voting members, it's 1 person, 1 vote, and 1 person isn't going to be able to sway the consensus of the Fed. Certainly not a voting member. The Fed chair has a lot of sway on the consensus. Fed Chair Powell's nowhere close to that. So 2 more rate cuts this year is what we could look for, and maybe 1 more next year, Rick. That's what our anticipation is.
Steve, anything else you'd like to mention?
Look, I think the end result of this, Rick, is where, when we think about where the Fed is, their big deal is they upped their growth prospects for next year. Now, they're still a little lower than we are on a growth prospect. We're a little more optimistic on growth as we move into 2026 and 2027. But I started our conversation by understanding why the Fed is cutting rates. We don't want a Federal Reserve that is aggressively cutting rates, because if that happens, that means we've had a pretty bad economic outcome. This forecast for only 4 rate cuts over the next 12 to 18 months That's a pretty optimistic viewpoint from the Fed that unemployment's not going to go much higher, growth is going to remain positive, and that may mean that inflation still coming down, but is coming down slower. In fact, their forecast is now they don't get to 2% until 2028. But overall, Rick, that's an optimistic viewpoint of how we're moving forward. That's a better economic outcome. And we can live with a little bit higher rates as long as the economy's continuing to grow. That's what we want to see happen.